Welcome students. So in the last part we were discussing the balance sheet of Grasim Industries, and I have explained that how good the balance sheet is, but so now we would like to confirm with the help of certain ratios that whatever we could see as a raw balance sheet about the company or its performance, is it the same while calculating certain important ratios, or there is some different information about it. So first we will be calculating the ROI ratios, return on investment ratios, and the first ratio in the ROI ratios was, that is the return on net worth. So we have discussed already the formula that how to calculate this ratio, and as I told you that is the PAT, profit after tax, and it has to be divided by the net worth. Net worth was the total paid up equity capital plus reserve and surpluses. So that is the net worth. I told you how to calculate the net worth, and the net worth can be calculated either from the asset side or from the liability side of balance sheet. And if the liability side of balance sheet, if you calculate the net worth, then we have to take the only the total paid up capital plus free reserves, and that is the only the figure of net worth. So we will take the PAT in the numerator, and if you will talk about the PAT in the numerator, so what is the PAT in the numerator, profit after tax in the numerator? You will find this figure in this is the here it is the PAT figure, profit after tax. So if you calculate the PAT figure, if you see, no need to calculate, this figure given to us is 1535.81, that is the crores for the current year. It is 1535.81 crores, that is 1535.81 crores figure of the profit after tax is given to us. And in this profit we will have to take some so we will make some adjustments, and once you make some adjustments, then we will be calculating the real PAT. So now for calculating the PAT, we will have to adjust the PAT, and we will have to calculate the adjusted PAT. We will not take this PAT as it is, profit after tax, we will not take it as it is. For calculating the ratio, we will have to calculate the adjusted PAT. So PAT here is, if you look at the PAT for this current year is that is 1535.81, 1535.81 crores, and in this you have to subtract something, which is means what you have to subtract is that kind of the income which is not the regular income. Any income which is once in a while, which is not a regular income, we will have to subtract that income. That income is of no use to us. For calculating the PAT, profit after tax, we should take the regular profits. They are from the profits which are normally from the operations of the firm, right? And if there is any exceptional item which is there in the one year but is not in the other year, if you take that into account, so what will happen? In one year, the financial performance of the company, profit after tax will go up very high, and the other year when the exceptional income is not there or that irregular income is not there, the profit will go down. So to keep it as a static figure or as a real figure, regular figure, you will have to make some adjustments. So here we will have to subtract some items which is given to us. Here is the, if you talk about, here is the profit before exceptional items. If you talk about the profit before tax and exceptional items, so profit before tax and exceptional items is this one 2189, and then we have added in this write back the provisions for the diminutions. So we had made some provisions, but now we have written back, this diminution was not required. So we have added this income back 37.10 crores. So that is not a very regular income, because you not write back all these provisions every year. Sometime it can be, sometime it cannot be. So why to take this into account? We have to subtract this figure, and when you subtract this figure, in this case you will find that finally your PAT will also come down. So your PAT will come down by 37.10, and if this comes down 37 this amount of the exceptional income is 37.10, and for calculating this figure we will have to find out that the amount of the PAT is changed. So what is this? That is the 1535.81 divide 0.81 crores minus 37.10 crores. You have to subtract, and in this case you have to add something, because this is the analyst job. Anybody cannot do this. this is an analyst job, because if anybody who is not aware about the say real financial analysis, then what they will do, they will take only this PAT, that is 1535.81 crores, and they will not adjust this PAT. So, one year the performance will be shown as very high, very good, other year the performance will go down. So, this is the job of the good learned financial analyst, that he should take into account the consistent figures, because convention of consistency is important. So, we are subtracting here the exceptional income, which is 37.10 crore, but you have to add here something. And now if you add here something, think about what we are going to add here now, because when this income was added, the profit has become 1535.81 crores, and when the profit has become 1005, or maybe if you talk about the profit before exceptional incomes, profit before tax and exceptional incomes, this profit was 22,189.26 crores. It means when this profit is there, in this profit we are now adding back the total profit before tax was, this profit became total profit became 2226.36 crore. This was the profit after tax, and this profit includes the exceptional income also, and when you include this 37.10 crores as exceptional income, it means we have paid the tax at the rate of 35% on this amount also. So, when we are subtracting this income, we should add back the interest paid. So, add interest paid on exceptional incomes, EIs. We have to pay, add back the interest paid on that, and that what was the rate of interest? That is at the rate of 35%, and if you calculate that rate of interest on 37.10 crore at the rate of 35%, then this works out as 1299 crores. So, this means we will have to subtract one figure and we will have to add one more figure. So, this is subtraction, this is addition we are making, and finally if you calculate the amount of the profit here, this works out as 1511.70 crores. This is the now final adjusted profit for the current year. And if you adjust the profit for the previous year also, because in the previous year also we have some exceptional income to the extent of 4.13 crores. So, we have 4.13 crores. So, you have to adjust that also, and finally you have to calculate the adjusted profit for the previous year also. So, this way we have calculated the PAT, and if you calculate the PAT, means to talk about the PAT here, then we will be talking, say that the numerator will be what? That is 1511.70 crores divided by net worth. Now, we will have to calculate the net worth also. Net worth should not be taken as the year end figure. Net worth we have also to adjust. For calculating the net worth, we also have to adjust. So, when we are calculating the net worth, what we are including in the net worth? Net worth means the paid up capital plus free reserves, Now, paid up capital has to be taken as it is, because paid up capital in this case especially, and in other cases also, whatever the paid up capital is there, that is the same in the previous year also, previous to previous year also, in the next year also, current year also, every year that is going to be same, because equity capital is not going to be paid back by the company unless it is going to be closed, though the buyback of the capital is allowed now, but normally it is not done by the companies, because unless the company is over capitalized. So, in this case we have to take the paid up capital as it is, which is in this case is 91.69 crores, but for the free reserves we will have to calculate the adjusted figure. Adjusted figure means that it is better always that you take the reserves figure as the average figure of the previous year reserve plus current year's reserve divided by 2. So, it should be taken, it is always better you take the average, because sometimes what happens that because of sometime uncontrollable circumstances, the profit may be more in one year and the profit may be less in the other year. It is not because that some exceptional has happened in the business, but maybe because of certain other factors. So, it is always better that for calculating the return on net worth ratio, so when you calculate the net worth, the free reserve should be taken as a average figure. So if you calculate the average for the 2 years, in 2006 and 7, that is ended on 31st March 2007, what was the reserve and surplus? That was the figure of 6138.35 crores plus the second figure, previous year's reserve was 4890.39 crores, and you divide it by 2. If you divide it by 2, you will find a figure here, that is 5514 crores. So this figure will be, the adjusted figure will come out, this will work out as 5514.37 crores, figures will be here. So it is the total now, that is 91.69 crores plus 5514.37 crores. This is the total net worth, that is the average reserve and surplus, total equity capital, and by total of these two you are dividing the numerator, that is a PAT, but PAT is also adjusted profit, there you do not take the exceptional incomes. So finally if you calculate the ratio on the basis of it for the year 2006 and 2007 and then ratio for 2006. So the ratio for the 2000 return on net worth ratio will be 26.97%. In terms of the percent you have to take, because you have to multiply it here by 100. So if you multiply it by 100, so you will get it in the percentage 26.97%, and then for the previous year this ratio is 18 point something like 49%. So these are the two net worth, return on net worth ratios. One is the say 26.97% and second ratio, previous year's ratio, that is the return on net worth, is 18.49%. It means it shows that there is an increase in the return on net worth as compared to the previous year. Current year the net worth has gone up. How much it has gone up? We will analyze it after we calculate all the three ratios. Then we go to the next ratio, calculation of the next ratio here, and that next ratio is EPS, earning per share. Let us calculate the earning per share. So you have got the figure of, so what we will take here, that is the, and we discussed the formula, that is the PAT, profit after tax, divided by the average number of equity shares. So it means we do not have any different number of the equity shares in the previous year and the current year or something like that. We have the same number of the equity shares and we are taking a rounded off figure for that. So you take PAT, again the adjusted PAT 1511.70 crores divided by the number of equity shares, and that is 9.17 crores. 9.17 crore shares in this case. So if you calculate the ratio for the current year, dividing this 1511.70 crore by 9.17 crores of the shares, this works out as rupees 164.85, and in the previous year this ratio was 93.84, rupees 93.84, and current year the ratio is 164.89 rupees. So it means earning per share, if you look at it, has also gone up. This is the second indicator, and the third ratio is cash earning per share, cash earning per share. So again I would like to discuss with you the difference between the two ratios, earning per share and the cash earning per share, right. In my previous lecture also I told you that there are the two ratios, earning per share we calculate, which is calculated with the help of PAT, and then we calculate the cash earning per share. And when we discuss the formula for the cash earning per share, we had a formula here like PAT plus non-cash charges, PAT plus non-cash charges divided by the average number of, means denominator is same, average number of equity shares. Now we are adding, for calculating the cash earning per share, we are calculating it with the help of PAT plus non-cash charges, and non-cash charges, largely the non-cash charge is the depreciation amount, right. Now why we add up this, the non-cash charge, in the PAT for calculating the cash earning per share. Sometimes what happens that when the firm is new and is in the initial years, what happens when we start a company or any business organizations, initial years you do not get the profit. First year of the operations will have a loss, second year also will have a loss, third year will also have a loss, but the fourth year, latest by the fourth year the company should reach at the position of the non-profit, no loss, which is called as the situation of the break-even point, and then from the fifth year, at least fifth year onwards, the company should start earning the profits. So what happens in the initial years when the company is incurring a loss, so it means the company won't be able to have any earning. That is because PAT, this is not a PAT, profit after tax, but there is a net loss. So when there is a loss, in that case also we would like to see whether the company has some cash earning with itself or not. So means out of the total expenses you talk about, whatever the expenses which are the cash expenses, material expense, wage expense, other direct expenses, salary, then your say whatever the other expenses you talk about, they are going to be paid to the different stakeholders who are supplying the materials, who are working in the firm, who are supplying this utilities, power, water and other kind of things. But only depreciation amount is the one which is not paid to anybody, that is kept by the firm. So though the firm has a loss, net loss reported in the first or second or third year, but still it has some cash available to pay its some contingencies, right. So non-cash payments, non-cash charges can be made use of for paying some emergent payments. So it is not the case that the firm has no cash, firm is paying all the expenses efficiently and firm is charging for the non-cash expenses also, but that non-cash is not going out, still remaining with the firm, and in that case some cash is available with the firm. So we calculate this ratio, that is a cash earning per share, that if it is a loss even, still it is a cash available and still some cash is there. So to pay some emergent expenses or unforeseen expenses, firm is in a position to pay for that. So that is why we calculate the cash earning per share, and when you calculate the cash earning per share, so we will have a PAT here. This PAT is 15, profit after tax is 1511.70 crores, plus we will have to add in this case the non-cash charges, and if you look at the non-cash charges here, you will find the figure of depreciation here, provisions and depreciation, and if you try to find out the provisions for depreciation, in that case we have one figure, that is depreciation and amortization, that is the last figure, 317.91 crores, 371.91 crores, that is 317 this figure is 0.91 crores is the non-cash charge, and again the denominator is the same, that is 9.17 crores of the equity shares. So now this ratio will be different ratio, and this ratio stands improved. So for 2006-07, if you calculate this ratio, this works out as 199.52 rupees per share, and in the previous year this ratio was rupees, if you calculate this ratio is 125.65 rupees. So it is cash earning has improved, because in the profit you have added the non-cash charges also. If you look at the cash position of the firm, that is about 200 rupees per share, and if you talk about the simple earning per share, which is the pure earning, which is the true earning per share, that is depending upon the profit the firm has earned, that is about 165 rupees. So there is appreciation, there is increase by 35 rupees per share, because total cash available is, including the non-cash charges, that is more as compared to the only profit after tax. So here we are calculating these three ratios, and if you look at these three ratios, that return on investment, that is return on net worth. So if you compare, if this is 18.49% and now current year is 26.97%. So what is the increase in the return on net worth? So if you calculate the percentage increase in the net worth, so the percentage increase in the net worth as compared to previous year is by 45.86%. Very good increase, substantial increase as compared to previous year, as on the return on net worth is, that is on the return on investment, you can say. Net worth means return on the investment, internal investment, which is as compared to previous year. In the current year 2007 it is 45.86%. If you calculate this percentage change in the earning per share, EPS has gone by 75.67%. that is EPS change in the EPS is up by about 76%, again a very good increase, very good change. And if you calculate the CEPS, cash earning per share, so in this case CEPS, the cash earning per share is also very good, has also improved seriously. CEPS, it has improved significantly, and if you talk about the cash earning per share, in this case the growth is by 58.79%. 58.79% increase is there in the cash earning per share. So it means if you talk about the overall three ratios, that is the return on net worth, then earning per share, and if you talk about the cash earning per share, in that case all the three ratios have shown very good appreciation, very good increase, and there is no doubt that this firm is really a wonderful organization, performing very well, doing a very good job, and means there is no problem that whatever we could see in this balance sheet without any kind of analysis, that if you look at the profitability position and if you talk about the other kind of the financial indicators, we could find out the same information by calculating the ratios, but the only difference was that when we look at with the say naked eyes or the raw balance sheet, then we calculate some ratios, and when you calculate the ratios we should be knowing how to calculate the true ratio, means what is the proper method of calculating ratios. If we are not the students of this particular subject, if we do not know the real financial statement analysis, then we can take the profit after tax as it is, we will not adjust it. So it will not be the right way. Similarly, when we take the reserve and surplus, we can take only the year and figure, but for calculating the this return on investment ratios, we should take the average figure of the reserve and surplus, not the year end figure. It is always better because it maintains the balance and it gives us a better information. So you should be knowing it, that how to calculate the profit after tax. So we have to take the adjusted PAT here, and then we have to take the average of the reserve and surplus. This is the financial analysts normally do, and if we are not knowing anything about, if we have studied the simple financial analysis without a proper say technique of analyzing the financial statements with the help of some ratios, then we can take the wrong figures, and that will help us to draw the wrong conclusions or wrong meanings. So in this case, as this case is very good, this firm is very good, without even any kind of analysis it shows that it is really a good performer, but sometimes you have to say confront with in a situation that when the firm is found as something different and not doing very well, balance sheet is also not depicting the good picture, but when you calculate certain ratios the picture may change. So in that case it will be really very useful to learn this kind of the analysis and the important points taken care of in the analysis part. So this is how we calculate the first set of ratios, that is the ROI ratios or the return on net worth ratios. And now after this we will learn about the second set of ratios, that is the solvency ratios. And in the solvency ratios, as we have seen, we have talked about the three important ratios, that is the return on net assets, that is the net asset value, NAV. Then we have one more ratio, that is interest coverage ratio, and then is the debt service coverage ratio. So we will be talking about those ratios now, and we will be learning how to calculate the NAV, how to calculate the say interest coverage ratio, and how to calculate the debt service coverage ratio. So these three ratios will be studying, will be calculating, and will be knowing about the overall solvency position of the firm. Solvency, as I have told you earlier, and the name indicates how solvent and the strengthful the firm is, how financially the powerful the firm is. That talks about the solvency analysis. Solvency and insolvency, two words. Solvent means, insolvent means bankrupt, and solvent means strong, financially strong. So when the firm is insolvent, it is financially very weak and it is almost insolvent, and when it is insolvent, when it is not able to pay for its liabilities or its obligations, and when it is solvent, then it means it's very strong, powerful firm, and it's easily able to manage its all liabilities, and whenever any liability becomes due to be paid, they have sufficient funds for that, and these liabilities can be easily paid. So now we will be learning the solvency ratios, we will be learning how to calculate the solvency ratios. Again, for the Grasim Industries, we will calculate the solvency ratios, and the first ratio that we learned in the previous part of discussion was, that is the NAV, or it is called as the net assets value. So for calculating the ratio, we will have to take the net worth divided by the total number of the, or the number of the equity shares outstanding, that is number of equity shares outstanding. This is how we calculate the NAV, or net assets value. Net worth divided by the number of equity shares outstanding. So what is the net worth of the company, and what is the total number of equity shares? So we will have to calculate the NAV per share. So it means what are the internal funds available and how many shares the company has issued in the market. Because if we have not earned any reserve and surplus in the net worth, if only equity capital is there and firm has not earned any reserve and surplus, because firm has not earned any profit, in that case NAV will be the same, that is only the share capital, as it is in case of the 91.69 crores. But when the NAV is improving, when the equity capital is appreciating, and when the equity capital appreciates only when the firm is earning the good amount of the profits. So, and in this case also we have seen that the initial investment was 91.69 crores, and equity capital even today is the same, even 2007 was the same, but it has total internal funds have gone up, means because of the reserve and surpluses, huge reserves and surpluses. Reserve and surplus figure, if you look at, we have seen that reserve and surplus figure is very high here, and that figure was 6,000. If you look at this figure, it is 6,138.35 crores. So it means why this appreciation is there? This appreciation is by way of the reserve and surpluses, and reserve and surpluses improve by way of the improved profits, and improved profits come because of the better financial management of the company, better operating management of the company, and the result of this is the increase in the overall net worth. And if the number of equity shares are remaining same, net worth is going up, it means the NAV will, net assets value will improve, because ultimately why we call it as a net asset value? Because this net worth is going to help us in financing the asset side of the balance sheet. If you want to say expand, you want to have more land, more buildings, more plant and machinery, more furniture, more other kind of fixed assets, we need funds, and only two sources are there, internal and external. So if you are not generating sufficient internal funds, you have to look for the external funds, and external funds can be only had to a limited extent, as we have seen that debt equity ratio can be only 2:1 normally. So, but in this case we have seen the firm has more funds generated from internal sources and less they are depending upon the external sources by borrowing money from the market. So now if you calculate the NAV, net asset value for this firm, what you have to take here is 91.69 crores as the equity capital plus reserve and surplus. But here point of concern is that the reserve and surplus you have not to take it as the average figure, you have to take the year end figure, because for calculating NAV we take the reserve and surplus as the year end figure, not as the average figure. Why we do like this? I'll tell you when we will calculate the second ratio, that is the debt equity ratio. So in this case now your equity capital is 91.69 crores we are taking as it is, and the year end reserve and surplus is how much? That is 6,138.35 crores, 6,138.335 crores, and divided by the number of equity shares, that is 9.17 crores. So if you calculate the net asset value ratio for this is, that is 679.38 rupees for this year, for the year 2007, and for the year 2006 this ratio is going to be how much? This ratio is 543.30. So now look at the net asset value. net asset value which was 543.30 rupees has increased by you can say a significant amount, and it has become, that is 679.38 rupees, that is the net asset value we have calculated. You can say it is the per share value. Net asset value per share is this much. So it means the net worth, the equity shareholders return is this much. It means if this firm is closed today, if this firm is dissolved today, if this firm is closed today, what will happen? Equity shareholders will get 679.38 rupees per share, and the per share is of 10 rupees. They have, if they have purchased it for 10 rupees, they will be getting 679.38 rupees. This is the book value of the firm we are talking about, because the other liabilities, the loans part will be easily adjustable by, say, getting the money by selling the assets in the market. So if you sell off the total assets in the market today, and then you start settling the claims, first of all we will settle the claims of the loan providers, lenders. So both secured and unsecured loans have to be paid first, and then after that fulfilling and paying all external liabilities, whatever the amount is left will be given to the equity shareholders. So this is the book value of the company, that the company will be generating this much of the real cash, and per share the net asset value is, in the current year, is 679.38 per share, that is rupees 679.38, and previous year it was 543.3 per share. So it means there is a good appreciation, there is a good increase, and this increase is only all attributed to the increase in the reserve and surplus because of the increased profitability. So when the profits are increasing, your net asset value is also increasing, and when the profit is static, net asset value is static, but when the profit is going down, net asset value is going down. Now apart from this ratio, we will be calculating the other ratios also, other solvency ratios also, what we discussed in the last part of discussion, and then we will draw the conclusion about how solvent this firm is, how strengthful this firm is, how financially powerful this firm is, and other ratios in this category I will be talking to you in the last part of discussion. Thank you very much.